Welcome to the weekly market analysis session. This is your investor trader conference call to give you an insight to what's taken place so far and what to expect for the week ahead. My name is Gavin Panu, and let's get through this. Okay, so what are the current market themes that I'm most concerned about? You as an investor trader, you need to sort of focus on what the short-term outlook is in comparison to the long-term macroeconomics. So these are your four current market themes that I believe that will have a large impact to how the market moves for the upcoming week. Now, bonds are showing us warning signs of a slowdown in economic activity, and that is only accelerating with yesterday's panic sell-off that we saw in the markets. I'll touch more on that a little bit later, but this gives you an indication that bond markets are leading the way for investors' decision making. Okay, so if you are using any indicator, you should be using an indicator that views the bond markets to give an indication where you should look to place your investments or your trades. So bond markets is at the focus. Earnings season is still around, even though it's not been talked much about in the last couple of days, but earnings season is getting underway. Last week was the first week. This week we've got a high number of earning releases. Keep your ears to the ground, should we say, see if there's anything that really stands out and can prop the market, as we've seen from the most recent panic sell from Monday's session. Housing data will be of focus from the economic standpoint on the economic calendar. Yesterday we had UK housing data released, and there's further housing data to be released for the week ahead. But the most anticipated macroeconomic data will be the ECB press conference as well as interest rate decision. Now, let's remove interest rate decision from this. I mean, the focus is going to be largely Christine Lagarde's conference. Okay, her statements is going to be key. Now, they have already made a strategic policy adjustment in regards to allowing a more accommodative stance and allowing the inflation rate to be above the 2% target. That's fine. We know that those changes have already been made. But we've seen recent rhetoric from other central bankers showing more hawkish stance. Now, that's the key, right? Now, is Christine Lagarde going to follow suit from the Fed's Jerome Powell from last week's testimony, continuing with an accommodative stance, or may she may adjust? She may adjust to the most recent rhetoric taking place with other central bankers. So keep an eye out for ECB's Lagarde's press conference. I believe it's this Thursday. Yeah. So let's come over to the economic calendar. Now, something of relevance, and especially to yesterday's sell-off, was what took place on Sunday. So on Sunday, we had the OPEC JMMC meeting. So this OPEC Plus meeting that had taken place. And so it's official. It's official that oil cartel are in truce. Okay, so, crude oil prices have fallen since this truce. As these allies have struck a deal to inject more oil into the recovering global economy starting in August. Now, the discussions are that they're going to be producing somewhere between, I think it's in the range of 400,000 barrels a day. Now, that's going to have a knock-on impact in the oil prices. Okay, so if we just have a look on the right-hand side when you look at my charts, let's just give it a moment. And let's come to WTI, crude oil. This is what we've seen following on from last week's session. Okay, so a large sell-off already occurring. We're in the 4-hour time frame. I mean, once reaching highs of $77, right? So $70 a barrel of oil. We're now back down to these lows around $66, $66.50. $66.50. So yes, a bit of a large. Well, I wouldn't say a bit, but a large sell-off has already occurred in the oil market. Okay, so that's following on from the meeting that took place all day Sunday, right? Now, the question is, does oil take part in what took place yesterday? Yeah, and I'll probably sort of come into that in a moment or so. I will probably come into that in a moment or so. But let me just stick with the economic calendar, and I'll come back to the slides and look at the charts thereafter. Right. So in addition to that, yesterday, I mean, the majority of this week is going to remain quiet. There's not a lot of macroeconomic data except for what I spoke about, which is, we're seeing earnings season's going to be in focus, especially with sort of, earning releases from a majority of those US companies and UK companies. In addition to that, we've got housing data being released. We've got one data that was already released yesterday, as well as ECB's press conference and interest rate decision on Thursday. Apart from that, there's nothing else, right? We did have overnight the monetary policy meeting minutes for the RBA, the Reserve Bank of Australia. Again, nothing too significant, but let's focus on the Rightmove HPI month-over-month data. Now, this is month-over-month data, which is a leading indicator. It gives me sort of a quick indication of how the short-term view looks like to go in line with the long-term approach. And we can see sort of a rise. Okay, so there has been a rise of 0.7% in the price of properties overall. Okay, so we're seeing a large amount of growth taking place, right? So I believe I have it here. So the average price of a property coming to market has jumped by 5.7% annually, right? And this is according to Rightmove. So prices have risen 0.7% over the last month. It is less than the previous month, right? It is less than the previous month. The previous month was at 0.8% for the month of June, but that was we were looking already for a slowdown in this, right? There was already a view that there was going to be a slowdown because naturally stamp duty was coming to an end. Okay, but how much of a slowdown was the question? And clearly, this is not a lot. Right? This is not significant. Okay, moving from 0.8 to 0.7 is not much of a slowdown. So overall, we can potentially see that prices of properties are still strong, still rather bullish. Yeah. Okay, and following on from that, just coming back down to sort of this morning. First thing this morning, we had the Reserve Bank of Australia. The focus would have been their minutes. Okay, the minutes is a guidance to what was discussed during their last interest rate decision and the two-day sort of meeting that occurs prior to outlining their stance going forward. Okay, and they've just showed a very cautious approach, right? So the committee are continuing to be flexible in their approach, especially with the uncertainty ahead and that they have restrictions. Okay, so I believe Sydney are under a 2-week extension of their current restrictions. Okay, so there is a lot more uncertainty when it comes to the RBA and Australia overall. The rest of the week, as I mentioned, this afternoon we've got housing start and building permits data, so more housing data in the US as we progress Wednesday. Wednesday seems more of a quieter day, but generally you're going to have the overnight, the monetary policy meeting minutes, again, more minutes from the BOJ. At the same time, we do have crude oil inventories, especially coming back on the back of that Sunday meeting. Thursday is a bank holiday in Japan. We do have the focus, which is, as I mentioned, the ECB press conference, the monetary policy statement, and of course the refinancing rate to be released. Friday, a lot of flash services as well as manufacturing PMI. Okay, so again, services and PMI, services PMI as well as manufacturing PMI data being released on Friday. But yes, let's come back over to the slides. Let's come back over to the slides to sort of highlight a few key points here. So these are your current market themes that I'll be focused on, as I've already mentioned. Moving on, what led to the sell-off that we saw yesterday, right? So what led to that sell-off yesterday? Now these are sort of the catalysts that I've defined as what could have caused almost a 900-point sell-off in the Dow. Okay. Now, it is not a single factor, it's a trifactor of factors that led to the panic sell-off, right? Well, firstly, a growing number of Delta variant cases. The UK has recorded its largest amount of cases. The US is starting to, the Delta variant is gaining in cases, and they're probably in the early stages of that growth occurring, whereas India's already had and dealt with the Delta variant, and it lasted just over a 2-month period. We're in the middle in the UK. We've still got another 2 to 4 weeks remaining to potentially see if we have peaked in regards to the Delta variant. But the US is just starting that starting that journey. And no one knows if there's going to be a peak in that variant, or if there's going to be other variants coming into play. I know France has their own variant of focus, right? So there are a number of factors, but all of these factors are a concern, right? These Delta variant factors and these other variants of COVID that are spreading, and is only encouraging further fear, further sort of negative, pessimistic view in the ongoing guidance going forward. Okay, and that means not just from a central bank, but also from a governmental standpoint, right? So the governments may step in and place more restrictions, right? Are they likely to provide fresh stimulus packages? I'm not too sure about that, right? In addition to that, the vaccine programs are coming along, but how much of an impact is it really having, right? Even though we've seen in the UK that's right, the Delta variant cases are growing, but there's less hospitalizations taking place as well, right? So there's a number of factors too, but it's all come together, right? So it seems like the Delta variant is it's taken a global spread now, and a bit of fear and panic has set into sort of investors' mindsets, right? And we can clearly see that. And the way to clearly see that is if we come over to the volatility index. Okay, this is your fear and greed gauge. Okay, so just looking at this, looking at the 4-hour, we can see a large push occurring, sort of, the average being around the 16, 17, 18 handle, with a push back up to sort of the 25 region. Okay, so if I go to the daily time frame, large push in the volatility index, showing there is some fear in the markets at this current moment. There is some fear occurring in the markets. Yeah. The second factor, in my opinion, is the OPEC news. For sure, it's going to be the OPEC news, right? That's going to have a knock-on impact, right? Now, what are they looking to do? They're looking to stabilize the price of oil. They don't want oil to overshoot and get up to a significant sort of, say, triple-figure amount, right? So, I mean, I was speaking about earlier on a few weeks ago, potentially, about option traders pricing in $100 a barrel of oil. But they want to stabilize this. It's clear that OPEC Plus want to sort of, keep where prices are at this current moment. They're happy to keep it between the 60 and 70 range, clearly, right? And what does that have a knock-on impact on, right? Now, the overall commodity sector has grown, has substantially, been the outperformer of all the other sectors. Okay, so that's going to have a knock-on impact on the commodity sector overall, and the commodity sector is going to have a knock-on impact on inflation levels. So inflation levels should sort of be tamer. It should be able to be tamed by from the energy costs perspective. When it comes to the CPI and the PPI data being released going forward. But that, again, is going to have an impact, not now, it's going to have an impact in the coming months. But again, commodity sector slumping is not a good scene for overall investors. Yeah. Now, that brings us to the final area. Now, what tends to happen when there is fear in the market? What tends to happen when there is a lot of fear, a lot of blood in the streets kind of situation occurring? Well, bonds become in demand. Okay, bonds become in demand. What tends to happen is traders start to sort of buy bonds or sell the yield, sell sort of interest rates, right? At the same time, you'll see investors allocating a portion of the portfolio into the bond markets. And that's what we've seen now. Recently, we've seen that bonds are becoming more in demand. There is more in demand. Now, if bond prices rise to compensate for that, then the yield must fall. It's just the way correlation works in regards to the bond markets. Okay, so that means there is demand for bonds, but there is the yield will fall for those bonds. Okay, so and that's what's taken place now. When yields are falling, that's just going to have a overall a broader risk-off scenario occurring, right? A risk-off scenario. What do I mean by risk-off? Is investors running away from high risky types of assets and moving to safer assets. Okay, so moving to safe havens. And that's what we saw yesterday, okay? But we didn't see a lot of that in the metals market, okay? Because of the OPEC factor, the commodity sector sort of, factor to it. Now, we did see, a rise in the USD. So if I come back over to, let's have a quick look at US 10-year yield. Okay, so this is the US 10-year yield. It's been growing as equities continue to rise, the yield rises, and the bond value, the bond demand has fallen, right? But now all of a sudden it's the opposite. Okay, so equity has fallen, yields have fallen, but the bond value rises, and that's what we're seeing recently. Okay, so that's what we're seeing sort of, over the last since sort of, I would say probably the peak reaching close enough to beginning of end of March, early April. Okay, so that's your when it comes to looking at the US 10-year Treasury yield. So with that risk-off sentiment, what does that naturally mean? So risk-off moving to safe havens. What are your safe havens? Well, let's start with the greenback, right? The reserve currency of the world, right? Now we see a large push occurring. So, overall, the dollar has been falling for some time, right? It's reaching sort of significant lows, testing around the 90 handle. Since then, we've pushed up higher. So twice it's tested this sort of region, right? So around the 93 to 93.50 handle. We haven't actually gone on to break resistance. We have not gone, have gone on to sort of, overshoot this key level of resistance around the 93.50, but we're coming back to sort of test this region again. Okay, so there was a lot of demand for the dollar, and there was of course demand for the yen, and I've mentioned why yen is also seen as a safe haven currency. Okay, so moving on, what does the overall performance look like from what's taken place so far? Now, the market performance, just looking at a quick overview here, you can see I've got some majors. I've got a few cross-currency pairs here. You've got dollar index. So dollar index, year to date is up 3.22%. Okay, for the month is up just over 1%. For the week itself, not much sort of occurring. We've seen a bit of a retracement in that, but overall, for the month so far, we're up 1%. Now, looking at sort of your pairs, your euro dollar cable. Again, do remember sort of that. They're highly correlated assets that tend to move in line with each other, but there's not been a lot of correlation as of yet, right? So we've seen, Brexit being a factor in regards to sterling, with most recent Brexit data showing some concern with what's been requested by Europeans, should we say, Brussels. Okay, so for the week itself, it's down by 1.02%. Okay, so it's had a larger knock-on impact. Now, is that down to the Brexit news that we've heard just recently? Is it down to we've seen a number of COVID cases rising, but also the PM has to isolate based on Sajid Javid. Now the health secretary testing positive for coronavirus, right? In addition to that, you've got Rishi Sunak, also the Chancellor of Exchequer, also potentially in isolation. And yeah, so all of that debacle that took place, has had a negative impact in sterling, even though we saw the UK 100, the FTSE 100 also fall. So they both moved in line with each other there. Well, I think the focus would have been is dollar strength overall. European, not much of an impact, as of yet, especially with the Delta variant cases. The only thing that I'll probably say is obviously we've had these floods occurring in Germany and in Belgium. That's the only sort of concern. Again, that's not going to have a significant financial market sort of impact there. Yeah, so Aussie Kiwi. Again, moving lower. So overall, you could see how it was a risk-off day, right? So you can see a risk-off day where there's a lot more demand for the dollar than there were for its counterparts. Okay, moving on. Now, looking at sort of equity markets, you can see here clearly, right, a substantially substantial down day, right? Not looking at today's, we're not looking at today's, right? We're seeing a bit of a rebound, bit of a bounce occurring, but for the week so far, you can see we've seen significant sell-off. A lot of the sell-off has occurred in your small caps, and that's large. That tends to happen in your Russell 2000 and 5000. But the Nasdaq, the 500, S&P 500, and the Dow, you could see sort of reaching sort of 2% in this region over here. UK 100 down close enough to 3.5%. So is the DAX, close to sort of 4%, right? 3.76%. So far looking negative. Year to date wise, the Dow is up close enough to 11.5%. The S&P 500 is around 14%. The Nasdaq used to be the leader, right? At some last year. But it's retraced substantially. It's retraced as we're seeing the sector rotation occurring, right? So rotation meaning that we're moving out of tech stocks going into more cyclical assets. So yeah, just be focused on that. Year to date for some of these equities, you can see it's still in the positive, but for the month, for the week, it's looking down. It's looking negative, risk off. Now coming over to some of the let's have a look. So what we're focusing on is the energy market. So we know about crude oil, and crude oil, you can see for the week itself is down over 11%. Okay, it's down over 11%. For the month is down 8.5%. But year to date is still, at one point it was close, it was above 50%. Okay, if I go back a month ago and I was looking at asset classes and their performance year to date is above 50%. So it has retraced some, but it's still up. Close enough to 37%. Brent is also up above 33%. Gold and silver year to date had just been lackluster. I don't understand what it is. Yesterday, I would have liked to have seen gold prop up significantly because of the risk-off scenario, and that just didn't occur. So I don't know what it is. I just don't get why gold and silver are lagging substantially. Maybe we're seeing that yesterday, the demand for bonds is where portfolio managers are reallocating their assets to sort of have a better proportion in safety assets like bond markets, but they don't want to go truly safe into gold, right? But also, inflation hedge wise, gold is a good asset to back as well. And you've not seen the sort of the inflation trade have that impact in gold. So gold for me is a very tricky one to trade at this current moment. Moving on to your yields, right? So we're looking at the major sort of 10-year yields. Okay, we've seen the US yield, which is in focus, has fallen, but so has the UK, Japan, Australian, and German yield. Now, moving on to where are these individuals, central bankers? Where are the central bankers in regards to whether they're dovish or hawkish? Okay, so dovish meaning dovish is more to the left-hand side, hawkish is more to the right-hand side. Market moving potential. Yeah, so which one will lead to more of a move to occur in the market? Okay, so this is how I've mapped it out. Okay, so Fed is the most dovish in my opinion. Fed is the most dovish, but it can also lead to the most market moving data or quotes, comments being made from the Fed. So just be aware of that. Whereas who's on the opposite end? RBNZ, the RBNZ. So they've already indicated that they're going to raise interest rates. Whether it's going to take place in August, September, November, those are the next 3 key meetings that are upcoming. We're not too sure, and there's different percentages and different probabilities assessed with each one of those. I think the focus for them, I'll probably touch on that a little bit later, but the focus is on their jobs report. Okay, so the jobs market. But RBNZ are already starting to, I believe, on the 23rd of this month, to reduce their asset purchasing program, which is a very, very hawkish stance, RBA are still, it's somewhere in the middle. They're still somewhere in the middle. They're still trying to be accommodative. It is market moving because it's going to have a knock-on impact in what we're seeing with the Australian dollar. But with the most recent restrictions being extended, there's still some uncertainty. The ECB are very, very close to the Fed, but not as market moving, in my opinion, with recent statements being released by Christine Lagarde, not seeing a huge impact in the euro as what I would like to see. The BOE are more hawkish than the ECB, but still, again, sitting on the fence. We know where BOJ is. BOJ has always been sort of, in a dovish stance. They've been, in their QE program for a very long time. But yeah, I mean, that's sort of the key central bank sort of stance in regards to dovish to hawkish, but also market moving potential. Now, following on to the final slide now, which is your macroeconomics overall from each of those countries, right? So looking at sort of the GDP rate year over year, and this is where you should focus, right? Now, do remember China, we're seeing sort of a green there, 7.9%. Is that a fantastic number? No, it's not. There's been previous years where year over year there were, GDP growth was, double digits. It was like, 10 to 12% in that region. So it's not as it was pre-pandemic, shall we say, as of yet, but still positive signs overall. Okay. For the quarter over quarter, we've seen 1.3%. The interest rates remain at 3.85%. Inflation is pretty stable. Jobless rate is around 5%. Okay, but in the US, looking at sort of their GDP year over year, it's at 0.4%. For the quarters at 6.4%. This is from a negative. Do remember this is coming back from the negative that we've seen, right? Interest rates remain at their lowest for historically, I believe. Inflation has overshot substantially in comparison to all the other central banks. Okay, at 5.4%. Jobless rate is falling, but it's slowing down in its fall. Okay, it's also a soft landing that's occurring there. So just be mindful in the jobless rate. I think that's where the focus is going to be next is, GDP and jobless rate, okay? And then, looking through to, let's have a look. So the UK GDP still remains negative. So that's where the focus will be for Andrew Bailey, the head of the Bank of England. It's recovered. There is some recovery from where we once were, but come on. It's far worse off in comparison to some of the other countries here. And looking at the interest rates, remains at 0.1%. Inflation has overshot their target as well at 2%, and jobless rates at 4.8%. So there are some concerns from a UK economic sort of standpoint here as well. Yeah. I think the most positive one in my opinion is probably potentially, as I mentioned, Kiwi. If you're looking at carry trades, if you're looking at what to be long in, I'll be looking at Kiwi. I think Kiwi is the new king for the short term. Okay, so we're already seeing that GDP is looking okay, so at 2.4%, quarters at 1.6%, inflation's at 0.25%, but it's not the lowest out of the majority, right? If you exclude China. So they've already given an indication that they're looking to raise interest rates now. Inflation has overshot. Okay, so that's why they're looking to react, right, to cool off sort of the inflation as we see there. But what will be a concern is the jobless rates. Okay, so any upcoming jobless data for Kiwi, keep a focus on this. That could be the only thing that has a negative impact on what they've already suggested. What they have already suggested, yeah. Okay, and I think that pretty much covers some of the slides that I wanted to cover with you. So yeah, just having a quick snapshot through. Okay, so gold, let's move up to, so in the daily time frame. So looking at gold, again, yesterday's session, what did it do? It fell. The value of gold sort of fell. Okay, instead of moving up, rising, it fell, but it did recover. Okay, so it had a sharp sort of pullback, forming sort of a long-legged, almost doji candle there, and we're seeing bullish so far. Okay, so that's sort of a key focus there. Looking at sort of the equity markets, the S&P 500. Now, this is something I did want to touch on, which is, let me just full screen this, right? Is that what have we seen over the last year, maybe 2 years now? Okay, so every time, from 2020 to 2021 now, every time there's been a substantial fall occurring, substantial sell-off, in whether it's a single day or a few days worth of sell-offs, what's taking place, it's also been where investors and traders have seen opportunity. They've bought in. Okay, they're buying the dip, as can be seen in this chart of here. This is post-COVID. This is post-COVID. So each time there is a fall, we've seen a recovery occurring, right? In fact, the biggest fall up, probably, apart from the initial, last year we saw sort of the March sell-off that had occurred because of COVID. If I just sort of measure from this peak up here down to this low, it's been a close enough to 10% sell-off there. So there's a 10% sell-off that took place close enough to sort of, September. So this was 3rd of September till 3rd of September to like 25th or 23rd of September. Okay, so we had September was a very bearish month overall, right? That somewhat didn't really recover back up to highs, but fell again. So September, October, November wasn't a great period, right? You can almost see that as markets were ranging. Okay, so markets were pretty much stayed within a balance in this sort of key zone here. Okay, so that's your sort of bull trend, a bit of indecision, waiting for more catalysts to come into sort of place, and that led to the sort of the next drive, equity drive higher, right? So now from this point onwards, every time we've had a sell-off, each time it's been bought. Especially sort of looking at the 50 period daily moving average. We're looking at the daily moving average 50 period, it comes crosses through, but bought back up. Crosses through, bought back up. So I'll be looking to see how this candle forms today, right? How this daily candle forms today, right? But we still have the US session to go, right? We still have the US session to sort of open at 2:30 this afternoon. But yeah, I want to see how this daily candle closes to give me that indication. Okay, is this the buy the dip moment, or potentially we may see a continuation in the pessimism that started off this week. And that's it. That covers the wrap for this week.